Welcome back. Continuing our conversation on the markets with Jyotivardhan Jaipuria, the founder and MD of Valentis Advisors, who's joining in. Jyoti, good morning. Thank you for joining in. The kind of moves that you have had on the market over the last 2 weeks, do you believe that someone who has a 1 or 2 year investment horizon, is it a good time to put money to work right now? Or would you rather wait for more clarity, not catch a falling knife, buy it 500 points higher, but buy it when there is more clarity?
Yeah, so almost see between the two options, there's always a middle option, which is start putting some money in. If we go back into history of wars and we've done that sort of analysis, so the average drawdown when war happens is roughly 7%. And typically what you found is on an average a month later, which is probably 20, 25 trading sessions later, the market goes back to the pre-war levels. So to that extent, obviously here nobody knows ever the timing of the war. But at some point, the impact on the market starts to come down. So these are all like opportunities, which are opportunities to buy really. The reason I said don't put all your money in one day, but stagger it out is obviously, in this war, India is directly affected because of oil prices. And, more than oil, I'm more worried about gas, frankly, if you ask me, than oil. So, that is one thing which we'll have to grapple with. But otherwise, the lesson is the same from all wars in history that there's generally been buying opportunities. The market beyond a point shrugs it off. Though the wars continues, like if we go back to the last one, Russia-Ukraine war is still continuing, but the market is not getting impacted by it. The market has, factored that in and moved beyond the wars.
Right. So, Jyoti, let's look at a little more, granularity out here. You earlier were a fan of some of the chemical names where you believed that, post the tariff-related uncertainty settles, they could benefit. Yes, the uncertainty is still there, but, the amount is a lot lower than what the street would have earlier feared, even if it's, 18%. It's 10, 15, 18 as against what was earlier. So that's a positive. But then this geopolitical tension and the impact of gas could have some sort of problems around, raw material availability or some sort of second, third order effects. So what are your thoughts on that? Point number one. Secondly, you liked metals despite the volatility earlier. And now, some of these non-ferrous names are picking a lot of pace because of supply-related concerns on account of these geopolitical, issues that we're facing. So would you hold on to those bets? Would you add more? Or would you think that maybe because of the near-term spike, it's good to book out from some of these metal names?
Yeah, so, Mangala, just starting with metals. So metals is something which we liked and we've seen that play out well. We continue to hold them, but at these prices, I would say not buy them. Because, just as a broader theme, there are a lot of companies or there are a lot of sectors which are benefiting because of the war scenario. But what to remember is if, there's a settlement on the war either way, Iran and US talk or, there's a settlement, some of these things can come down quickly. So on a very tactical basis, you may want to buy it. But for us, generally, we don't really do tactical trades. Mine would be, don't buy these and don't chase some of these themes. So we continue to hold the metals names. We like them. But yeah, they've had a spike, and at these higher levels, I don't think one should enter here. Second is chemicals is a little more interesting because, yes, we liked it because the tariffs had come down, but they are getting hurt in two ways, just now. So one is, the raw material volatility. So raw material prices, obviously, for all the metal names are going up. And to some extent, they may not be able to pass it down in the short term. But the other thing which is happening is just the freight and the ability to ship out, because anybody who's dependent on exports, like even to the Europe, freight costs have moved up. Insurance costs have moved up. So I think, all of them will have a poor March because, probably all of them will hold back on their sales. Even the customers will say, don't sell to us, don't send us the material now because the logistic costs have become very high. So there'll be some weakness in the March numbers. And for us, it would be if, the share prices come down and they react to that, then we want to buy it because once things normalize, then the demand will pick up again.
Okay, you spoke about the second order effects in your note as well. Remittance is something we were just talking about. It finances 42 to 47% of our CAT. $51 billion is a big number. How much of these secondary effects are actually priced in at the moment? And when you talk about deploying cash in this correction, any specific names you could point us to?
Yeah, so, some of these are priced in. Obviously, we've seen a move in the currency. And it's not like, all of these remittances will disappear. At the moment, if you think like where are we looking at the war, all of us are thinking this is like one short thing which we'll get over in weeks rather than years. So to that extent, there'll be a temporary impact, but then the remittances will come back because ultimately the Middle East will need to rebuild. So it's not like, it will be the end of the rebuilding phase. There will be some strain on their government balance sheets as a consequence of this war. But overall, I think it will not be such a big thing. It's more a near term. Next few weeks, we may have a struggle on the currency. Now, what do we like? So for us, very short term, I would say we are trying to avoid stuff which gets impacted by the war, either in terms of freight and logistic costs or in terms of, oil as the raw material. We still like the banking names, which, we continue to think they are very cheap and, they are largely unaffected by what is happening in the Middle East. But a lot of our focus continues to be domestic. So banking is something we like. We like some very select, names on the capital goods side. And of course, metals space. Pharmaceutical is one other area which, we continue to like at this moment.
Jyoti, pleasure having you as always. Thank you so much for sparing time and joining us. Looking forward to having you more often on the show. Jyotivardhan Jaipuria there with his views on the markets and the road ahead. Take a short break. Get to the management of Sami Hotels on the other side to talk about their acquisition and the sentiment check on the hospitality space as well due to the ongoing war in West Asia. Stay tuned.